Hi forex traders, you're welcome back. This is Carrie's Trading Institute and you're welcome to ICT forex analysis for the dollar and foreign currencies. Alright, so what we are going to do is we're going to analyze the dollar and foreign currencies ahead of the market open. This is Sunday 26th of March 2023. So it's good we position ourselves ahead of time, ahead of the market open, so that we know where the institutions are going to be looking at to trade into liquidity. All right, liquidity is the main driver of the market, so you need to know where institutions are looking at in the coming week. So the first thing we need to do is to go to forexfactory.com to have an idea of what is going to happen in the coming week from a fundamental perspective, and to know whether or not we are going to have a high volatility day or week, or we are not going to have a high volatility day. It's important we take note of these things, all right, so that we'll be able to blend the economic happenings, all right, with the price action. Okay, so there are 3 to 4 things you need to take note of on the economic calendar. Number 1, you are interested in taking note of high and medium impact news events. The medium impact news event is signified with the orange box you see here. That's medium impact is expected. Then the high impact is signified with a red box. You can see it here. High impact is expected. So you take note of the color of the box, whether it is high or medium. Secondly, take note of the time and day. So day, then time, and then the currency the event is happening or going to happen on. These are the things you should look at. High or medium impact, what's the day, what's the time, which of the asset or which of the currency are you expecting to see that high or medium impact news event to unfold on as the week open and as price action unfolds itself in the coming week. So on Monday you can see that we are expecting a high impact news on GBP around 6 p.m. This is a good event, but the timing is not good for trading, all right, because this is pound. It would have been better if we had seen this happening in London or New York session, but because it's 6 p.m. it wouldn't make any sense to us. Then on euro, it's coming up on 9 a.m. It's a medium impact news by 9 a.m. Then on Tuesday, if a news event, a high impact news event is coming on the pound by 9:45 a.m. So if you are trading the pound dollar, this is a very good day to trade, and it's also coming on the dollar by 3 p.m. all right, so you just go through the economic calendar and take note of these dates, time, currency or asset, and the type of news event that is unfolding. Okay, so what's the logic behind this? The logic behind this is that in days where we do not see a medium or high impact news events on the economic calendar, it tells us that we are going to have a low volatility day or week. Okay, once you see that there is no medium impact, there is no high impact news on the economic calendar, just reduce your expectation, or you can stay on the sidelines, because you are not going to see liquidity injected in the marketplace. The market may go into a long period of consolidation, all right, so that contracts can be accumulated, or it's also called time distortion, a period where there is no volatility in the market. The institutions may just like to accumulate orders in a range of consolidation. That's what usually happens. All right, guys, so once you are done with this, we need to go to the dollar index quickly so that we determine the direction of the dollar. And what we are interested in finding out on the dollar is the institutional order flow of the dollar, all right, beginning from the higher time frame, because remember the higher time frames are the main drivers. Okay, the draw on liquidity usually resides on the higher time frame, so but it forms from the lower time frame. So 3 ways to define institutional order flow is, first, to look at where price has traded away from, where price has traded from, and where price is currently. Okay, where has price traded away from, where has it traded into, and where is price currently. Just three things: where has price traded away from, where has price traded into, where is price currently. So price has traded from a region of bullishness. If you just study previous price action, price has been bullish because it's been forming higher highs and higher lows. This is structure, normal higher highs, higher lows, higher highs. All right, or we can just say this is accumulation, expansion, reaccumulation, expansion. Price traded into a premium institutional reference point by the left. So price traded away from a region of expansion, okay, to the upside. Price traded into a premium institutional reference point. What is that premium institutional reference point? It's a bearish breaker. What do I mean by premium? The concept of premium and discount simply means you buying an asset when it is cheap, all right, or at a discount, okay, and you sell it when it is high or at a premium. Okay, how do we identify premium and discount market? You simply pick up your Fibonacci tool and identify or define a trading range between a high and a low. So if you just define this previous trading range between this high to this low, 50% of that range is called equilibrium. So let's do it and see quickly. The high to the low there, that is the trading range by the left here. 50% is right here, and that's equilibrium. Above 50% is called premium, below 50% is discount. So we like to sell in a premium and we buy in a discount. Just like when price expanded above 50% here, it was in a premium. We don't want to buy in premium. We should allow price to trade into a discount. Price returned into a discount institutional reference point, and then price expanded into premium. So this is a very good place to sell because price traded into a premium bearish mitigation block. Okay, if you are struggling to understand the bearish mitigation block and breakers, just quickly go to the channel, search for the video I taught about institutional reference point, and you're going to have clarity on the difference between a mitigation block and a breaker. All right, but a quick recap is that we said in defining a mitigation block, we need to see a failure swing, okay, then a break of structure or a shift of market structure. So failure swing, price could not take out the high there, then it broke the last order block right here. The bullish order block there was broken. All right, we should expect to see price return to the mitigation block. All right, a breaker is when you have liquidity taking on two sides. This is top hunt, then this is top hunt, then price break structure. All right, we should expect to see price return to the breaker right here, that bearish breaker. Okay, now when you are using institutional reference point, in their order of importance, we pay attention to the mitigation block, which is first, the breaker block is next. So if you are looking at price, start by looking at mitigation blocks. You are looking for where the mitigation block is. If it's not there, look out for breaker block. If it's not there, where is the liquidity void? If it's not there, where is the fair value gap? If it's not there, where it's the order block? If it's not there, where it's the rejection block? If it's not there, where are the old highs or old lows? That's how to treat price using institutional reference points, because that's where exactly the institutions are looking at. Reason being that price is algorithmic, price is not random. All right, if price is moving from point A to B, there's a specific reason why it has to move from this point to the other. It is 100% algorithmic. All right, so having said that, now we see that price traded into a bearish mitigation block. Failure swing, that's a characteristic of a mitigation block. Failure swing, shift of market structure, the body of the candle has closed below that low, that's a mitigation block. So confluence of a premium region or premium array, right, premium institutional reference point, it's in a premium level. The mitigation block, which is the first in its order of importance, confluencing with a fair value gap or liquidity void, that's high probability. Okay, that is why you see the sharp drop on the dollar. It's not just random. So what happened on the dollar currently? Where is the dollar at? The dollar is the dollar traded into a discount level of this current trading range between the low here, this low, to the high there. The dollar traded into 50%, below 50% of this entire range, and below 50% we said is discount. So it traded into a specific institutional reference point below 50%, which is the buy side imbalance, sell side inefficiency, all right, or just call it the fair value gap. The low, the high of the first candle, because fair value gaps are a 3 candle price action where the high of the first candle in a bullish order flow, the high of the first candle is unmatched with the low of the third candle. That's a fair value gap. Okay, so you can see it here. The high of the first candle is unmatched with the low of the third candle. So this is 1, 2, 3. High of the first candle unmatched with the low of the third candle. That's fair value gap. So price traded into it, and this fair value gap is below 50% of the Fibonacci tool. That is a discount. All right, so we see how price sharply traded up, took out liquidity above the previous monthly highs. The last three months, all the liquidity residing above it, price took it out, traded above it. So institutional order flow is identifying the willingness of the monthly candles to take out the previous monthly lows or highs. That is what tells you whether you are bearish or bullish, all right, near term or intraday. Okay, so on the monthly, we can see that it's been taking out the previous monthly highs right here. Took out the previous monthly at the 2 months high, took it out. That is telling us that price is showing willingness to go up. Why does it have to go up? Because there's a draw on liquidity to the upside. What is that draw on liquidity? Now this looks like a smart money reversal. Look at how all this while price has been bullish, we didn't see a heavy pressure to the downside. Okay, but the fact that we've seen this is actually smart money reversal. I would like to see the dollar trade into a premium level of this range, the high to the low. I'd like to see it trade into this bearish order block right here. The bearish order block right there is also confluencing with a volume imbalance right here. This is bearish order block. Okay, the last buy candle here that was traded through to the downside and engulfed by these 2 bearish candles. So the high of the green candle to the low of the green candle, that's a bearish order block. We are paying attention to the candle open because we are on the monthly time frame. So I want to see a level of bullishness into that level, and also because there's an imbalance here. This is a sell side imbalance, buy side inefficiency. The last time price was delivered, we saw a one-sided price delivery without an opposing side. Okay, so that is actually a sell side imbalance, buy side inefficiency. So this is the weekly time frame. I still want to see the dollar trading to, I'm expecting to see the dollar trading to these levels before it continues to trade into deep discount and possibly take out sell side liquidity residing below these levels, and let's see what happens. So on the weekly time frame, you can see that the dollar actually traded into a specific level on the weekly, which is that discount fair value gap. You can see it on the weekly, very refined. Took out sell side liquidity residing below these relative equal lows. The body of the candles, you can see they are very equal. Institutions traded below it, traded into that discount fair value gap. Then we saw that fast or sharp expansion to the upside here. Okay, then price traded into a rejection block, right here. That is a rejection block. If you don't know what a rejection block is, please search on the channel. I've really taught on this thing, so I don't want to spend much time on this commentary. It's just a weekly analysis so that you understand where the direction of the dollar is. Okay, so price traded into that rejection block, and look at the sharp rejection to the upside Where is it going to go to? I'm expecting to see it trade into this level. And why is that? Because there is buy side liquidity residing above this high, and there is a drawn liquidity right here. This is fair value gap, the low of this sell candle and the high of this sell candle. That's an inefficiency. You can call this sell side imbalance, buy side inefficiency. We need to see institutions trade above this high and possibly reprice into this premium level. If you use your Fibonacci and mark out the high to the low of this range, we need to see trade into premium level, which is above 50% of the range, before we continue to the downside. All right, so a simple hack to determine where the drawn liquidity is identify an old high or an old low that is yet to be traded into, then identify an imbalance above it or below it. That's where the drawn liquidity is. So in this case, we have an old high here, we have an imbalance above it. That's where the drawn liquidity is. Okay, coupled with the fact that we still have an imbalance on the monthly time frame. Then on the daily time frame, what I'm doing now is top-down analysis. I'm showing you from the monthly down to the weekly down to the daily where the drawn liquidity is. Then on the weekly, let's look at what happened on the weekly time frame. On the weekly time frame, previously what we had is price took out liquidity residing below this low. Then we had a shift in market structure, created a breaker block right here. Okay, price created a breaker. Remember, the concept of the breaker is simply the other block that was violated. So this is the last buy candle that was engulfed by these two sell candle. That's the breaker block. Okay, so price created a breaker block, and also price created an imbalance here, buy side imbalance, sell side inefficiency that wasn't filled up. Okay, this is also a bullish order block. So price expanded, took out liquidity residing above old high, right, traded into volume imbalance by the left here. We identified these levels before it happened, and price really traded into those levels. What is a volume imbalance? It's characterized by conditions where you have only the wicks of the candle without the body of the candles engaged in that price action. That's a volume imbalance. All right, you can see this gap right here with only the wicks, candle wicks interacting between themselves. That's a volume imbalance. You can see one here, very tiny, and look at how the institutions traded into them precisely. Volume imbalance. The gap, just the wicks in between the bodies. The gap is between the candle body. Okay, the gap is between the candle body. You can see it here. Look at what happened after the gap was created. Look at the precision. Institutions went into it specific, went into it, repriced into that gap, and traded down. Okay, it happened here. They went into the gap again, traded to the downside. So took out liquidity above that high, then went into that volume imbalance. Now this is the questions many of you ask: how many times should a fair value gap be tested or retested? How many times should an order block be tested or retested? And most of you think that because another block was traded into, it will not be retried or retraded into. That's not true. Another block or any institutional reference point can be traded into as many times as the institutions would like to do so. All right, so went into that level and we had a shift in market structure to the downside. Okay, you see I'm taking my time to study price action so that I now have clarity on where the institutions or where the algorithm is taking us into, is driving us into. Trading into that level, took out buy side liquidity above that high. Then we had a shift in market structure to the downside that created what? An imbalance. Sell side imbalance, buy side inefficiency, one-sided price delivery without an opposing price action. Okay, confluence of a breaker, the last bullish order block, these two sell candles that were engulfed by that buy candle, that's the breaker block. So was created right here. Let me outline it for you so that you see. That's the breaker. So breaker here has a fair value gap or a sell-side imbalance, buy-side inefficiency attached to it. Pay attention to that fair value gap. So remember, last 2 weeks we were paying attention to this level, and price traded into that fair value gap and crashed directly into what? A discount institutional reference point. Low to the high. This is the daily. Between the low to the high, 50% is here. Institutions reprice into a deep premium, into a deep discount, forgive me. Institutions repriced into a deep discount. Okay, so what are they looking at in this discount or premium level? They are looking at institutional reference point in their order of importance as I outlined. Remember, I said in their order of importance is the mitigation block. If it's not there, the breaker block. If it's not there, liquidity void. If it's not there, fair value gap. If it's not there, order block. If it's not there, rejection block. If it's not there, old high, old low. That's how to use institutional reference point, or what many of you call, like how ICT calls it PDRE. Most of you don't know how to use it. This is how to use it. When you are looking at price action in premium and discount, you are looking at it with respect to institutional reference point in their order of importance. Okay, so let's study and see which of those institutional reference point did the institutions respected. So let's identify this range, the high, the low there to that high. That's our current dealing range on the daily. Okay, and then look at this. As price action was trading down, is there a drawn liquidity? Yes. What was the drawn liquidity? Sell side liquidity residing below this low. We outlined these things, remember, last week. The sell side liquidity residing below that low. The sell side liquidity residing below that low, and remember the gap below it, this imbalance below it, and a breaker block. This is a breaker block. It's the second in its order of importance. Second, it's not a mitigation, it's a breaker. Liquidity below was taken, then we had a shift of market structure. That's a breaker block. Okay, unlike mitigation, we need to see a failure swing before. So this is a typical price action between two breakers. Look at this. This is a model. Price took out liquidity above, shift of market structure, price returning to the imbalance. This is a breaker price action. Price traded into another breaker by the left. Breaker, all right, bullish breaker here. Buy candles or bullish, or bearish order block, which is the buy candles that were engulfed by the sell candle. That's a typical bearish order block, but it was violated here. A bearish order block is supposed to support bearish price action. A bullish order block is supposed to support bullish price action. Okay, so for the fact that this bearish order block could not push price to the downside tells us that there's a heavy buying pressure. Okay, so this is a bullish breaker. This is a bullish breaker. Institutions traded into that breaker, the high of that buy candle there, the other block that was violated, high of the other block that was violated. You can see that. So we are looking at confluence, more than one reason to execute a trade. That's confluence, more than one reason. That's what we're trying to do. So what's that more than one reason? I have a breaker, bullish breaker. There's an imbalance that was closed. Okay, then there is a bullish order block right here. That's more than one reason. I have like 3 reasons, 3 institutional reference points supporting a bullish price action on the dollar, 3 institutional reference points supporting bullish price action on the dollar: a bullish breaker, a bullish order block, a sell side imbalance, buy side inefficiency that was closed, and also a discount level. The low to the high, price is below 50%, is also in about 72% or 78% Fibonacci retracement level. That's the discount. Right, guys, that's deep discount. That is deep discount. Okay, so what are we looking at this week? I'm looking to see price trade into what levels. Remember, on the weekly, the buy side liquidity, or the buy side liquidity pool residing above that weekly old high, and should trade into that already outlined weekly sell side imbalance, buy side inefficiency. That's what I'm looking at. All right, in the next coming weeks, that's where I'm looking at. But currently, what has the dollar done? Dollar traded into the bullish order block. Then let's go to the 1 hour and see. On the 1 hour, price traded into that level, and price gave us a shift of market structure. How? Price swept liquidity below here and gave us an expansion to the upside. It's called smart money reversal. This is a typical of market maker buy model. Why? Right, price has been forming expansion, expansion to the downside, accumulation of contracts, expansion, reaccumulation, expansion, reaccumulation, expansion, reaccumulation, expansion. Then we have suddenly smart money reversal. Okay, smart money reversal here. Institutions went into a low risk buy. What is that low risk buy? Institutions traded into a bullish order block. Now this is not just a smart money reversal, this is also an SMT divergence, because if you put up the pound dollar, the euro dollar, you'd see that one of them could not form higher high, because as the dollar was forming lower low, we should expect to see GBPUSD forming higher high, euro USD forming higher high. Once there's a crack in that correlation, it is smart money divergence. Let me prove this to you. So let's just go to the GBPUSD chart, see if it has, or if it formed higher high as at the time that was happening. Okay, so this is the GBPUSD chart. GBPUSD formed higher high, quite all right. Let's go to euro USD, see if euro USD formed higher high. Once that doesn't happen, what we have is a crack in correlation. Okay, so this is the euro USD chart. This is, so price formed higher high here on the euro USD. Price formed higher high as well on GBPUSD. Then on DXY, price formed lower low. So we do not have a smart money divergence. Okay, we need to see a crack in correlation to say it's an SMT divergence. So what we had here was price traded into that level, gave us a clear expansion to the upside, showing willingness to go up, then traded into a bullish order block, then broke structure. Now we have a shift in market structure right here. So what we have here is a mitigation block. Why is it a mitigation block? Look at this. Price from the high, low, broke structure. So this is higher low, broke structure. Failure swing. Price could not break out that low. That's a failure swing. So what you have here is a mitigation block. So where is the dollar going to go to this week? I need to see either a gap open higher or lower to know the direction of the lower and the direction of the dollar. So what you see here is that the dollar, look at this, the dollar gave us a gap opening lower. You can see that, right? A gap open lower. So this is telling us that the dollar is going to be bearish, probably between Monday, Tuesdays and Wednesdays, to trade into an institutional reference point to create the low of the week before it starts to trade into higher time frame drawn liquidity. Okay, so where am I looking to see the dollar trade into? I'm looking to see the dollar trade into these levels, the internal range liquidity here, the imbalance there, I'm outlining my point of interest. Okay, the imbalance here, and possibly sweep the liquidity residing below this level and trade into that bullish mitigation block on the 1 hour that has a fair value gap. This is really a high probability for me where I'm looking to see it trade into. I'm looking to see the dollar trade into this level at least to form the low of the week before it starts to trade into that higher time frame PDRA. Okay, and I'm expecting to see this happen between Monday, Tuesdays, and Wednesdays. I need to see the dollar trade into this level. All right, if it trades into this level and gives us a lower time frame confirmation, we would go bullish. We should, but more preferably, I need to see it trade into this level because this level has been left untreated and untraded into. Okay, you can see the fast and the speed of delivery it's coming from. Just from this candle opening, you can see that it's showing willingness to go down. It should trade into this level. All right, so that means once it trades into this level and it gives us a lower time frame break of market structure to the upside or shift of market structure to the upside, then we buy the dollar and we sell foreign currencies. Let's quickly analyze the GBPUSD 1 hour time frame, or let's do from the daily. From the daily time frame, look at what happened. From the daily time frame, GBPUSD traded into, took out buy side liquidity residing above that high and traded into a bearish order block main threshold. This last buy candle that was engulfed by a bearish candle, that's a bearish order block here. So GBPUSD traded into that level, and look at this, we saw a sharp reaction to the downside. Okay, price created a bearish order block. Currently, I like to see price trade into this bearish order block to form the high of the week before it starts to trade to the downside. All right, so where is it going to trade to? Where is it on liquidity on this daily time frame? I'm looking at this fair value gap right here. I'm looking at this fair value gap. I'm looking at the old low here. I'm looking at this imbalance here. All right, you can see that, and I'm also looking at this level. Okay, but I'm looking at the pound dollar trading into this bearish order block. Then it should trade into this bullish order block on the daily that has a fair value gap attached to it, or take out sell side liquidity in the long run in the next few weeks, trade into this level. This liquidity void, okay, might be refilled, or price may trade into 50% of this bullish order block. That's on the daily. On the 1 hour, let's see what happened. So price traded into that level and we saw a shift of market structure. We saw a shift of market structure right here. Okay, I would like to see, just in the same way, I would like to see the GBPUSD trade into at least this fair value gap. All right, you can see this is a bearish order block, or as well check out the buy side liquidity residing above these relative equal highs and trade into this fair value gap right here to form the high of the week before it starts to go down. That's what I'm looking at. I'm looking at these levels, the fair value gap here with the bearish order block. Okay, price formed the lower high, then broke structure. So I'm looking at, you can see this is the mitigation. I'm looking at this candle here, so price should trade into that level, and this is confluencing with that daily bullish order block I outlined, daily bearish order block I outlined. think so. Okay, so let's outline the bearish order block on the daily. So that's it, that's that level, that's the bearish order block on the daily time frame. I like to see it trade into that level, then before it gives us a clear displacement to the downside, we execute when price returns into internal range liquidity, fair value gap, or bearish order block on the 15 minutes. That's how we're going to do, and this is what I'm looking at on the dollar and foreign currencies. You're going to get more updates from me as the week progresses and as price action keeps showing us where the institutions will likely trade into during the week. So guys, please, if you like this video, I would like you to click the like button. Don't forget to subscribe to this channel. All right, and until next time, I wish you good luck, good trading. Just in case, if you want to join my private VIP forex mentorship, you can also check the link in the description of this video and reach out to me so that you can enroll for my private forex training and mentorship. Okay, if you're also interested in joining my free Telegram community, okay, you can also check the link in the description of the video. Join my free Telegram community, stay updated, get amazing videos and video content, teachings and lessons. Stay safe.